Many people think trading, investing, and speculation are the same thing. They all involve markets. They all involve buying and selling, and they all involve risk. But similarity on the surface hides a fundamental difference underneath. The difference is not the market. It is the intention. Welcome to the phantom trader world, where clarity comes before execution. Investing starts with belief in long-term value. An investor is not focused on today's price. They are focused on what something could become over time. When someone invests, they accept uncertainty in the short term because they believe time is working for them, not against them. That is why investors talk about fundamentals, business models, growth, adoption, economic cycles. Time is the main tool of investing. Trading approaches the very same market from a different angle. A trader is not trying to own value. A trader is trying to operate movement. The question is not, is this asset good? The question is there an opportunity right now? Holding longer does not automatically reduce risk. Sometimes it increases it. Trading is about structure, timing, and probability. It accepts uncertainty and focuses on managing it. Speculation may look similar to trading on the outside, but internally it is very different. Speculation is driven primarily by expectation without structure. A speculator reacts to stories, headlines, hype, emotion. There is often no defined risk, no clear exit, no repeatable process. The decision is not based on probability. It is based on hope. Real-world examples make this difference very clear. Someone who buys an asset because they believe an industry will grow over the next 10 years is investing. Someone who enters a position because price is reacting at a specific level with a defined risk and a predefined target is trading. Someone who buys because everyone is talking about it without a plan is speculating. The same asset, three completely different behaviors. This is where confusion becomes dangerous. Many people believe they are trading while they are actually speculating. They use trading language, but speculation logic. That is why results feel random and why confidence disappears quickly. Professional market participants are very clear about the role they are playing. They do not mix intentions. An investor does not panic because of short-term noise. A trader does not rely on long-term hope. And a professional avoids uncontrolled speculation entirely. Problems begin when roles overlap without awareness. You cannot judge investing with trading rules, and you cannot survive trading with speculative behavior. None of these approaches are wrong by definition. What is wrong is confusion. Markets reward clarity. They punish inconsistency. Understanding the difference does not tell you what to choose. It tells you how to behave once you choose. And behavior always matters more than labels. If this video added clarity to how you see trading, support this work. An interaction tells the algorithm this foundation matters. A subscription tells me to keep building it with you.